Well, we have to move on to our next management. And as we do that, just a quick glance on the screen. The fall has been arrested. That's the good news. The Nifty is now actually trying to claw its way back to the 23,000 mark again. It's a 100-point dip now, which is better than where we were at the open. So looking slightly better. But moving on very quickly to the next set of numbers. IDFC First Bank is the next stock on our radar. We have the management with us. The third quarter earnings came in slightly below estimates, one could argue. The slippage ratio, of course, is something that the street is looking out for very, very carefully. We have Mr. V Vaidyanathan, Managing Director and CEO at IDFC First Bank, joining in. Mr. Vaidyanathan, morning, and thanks very much for joining in. I was looking at the basic numbers, and we'll just highlight that for our viewers as we start. Your gross NPA ratio has remained largely steady. I mean, 1.93 in Q2 and now 1.94. That's not the problem. But I think everyone's trying to understand what the situation is in terms of rising slippages. What are you seeing in the unsecured segment, in the overall retail book? If you could start there.
Okay, the really good news is that the slippages have not risen. If the last quarter to this quarter, slippages have not risen, which is really good news. Actually, analysts are penciling in a 20% increase in slippage as is seen for the rest of the industry. For us, excluding MFI, it is practically flat. MFI is a known issue, so that has increased. And MFI is a cycle. It's a cycle. It'll wind itself way down as the industry gets back to its feet on the front. So the important thing is that from the NPA point of view, let me just share some numbers with you. At a bank level, all excluding MFI, our SMA is only 0.71, quite stable over the prior quarter. GNPA is 1.81%. And NNPA is 0.49%. But the MFI, I must point out, is the gross NPA is 4.5%, SMA is 4.5%, and NNPA is 1.1%. So it's a very specific, isolated issue of MFI. Rest of the book is, as you can see from the numbers, is really stable, and we're quite happy about that.
I'm going to bring in Latha in the conversation in just a minute. She's also here to take some questions. But just to complete the point on asset quality, if you could tell us, by when do you see the MFI pain peaking out? There are different estimates there. Some people say Q4 is the worst. There are rating agencies saying this will go on till second half of FY26. So what is your reading on MFI? And also the rest of the retail book, X of MFI, can you say now with confidence that you will not see any kind of further deterioration in the retail book?
So let's take them one by one. On the MFI front, our estimates are that the quarter that's going on, Q4 of FY25, will be the max provisions. And we feel that Q1, it should come down, and Q2 should be less than Q1 26, Q2 26 should progressively come down. Because the life of these loans are typically, 2 years, and 1 year has already gone by. So mathematically, it should go there, but we should be very careful. There's just a lot of moving dynamics here, industry changes, and so on. But that's what our analysis is. Now, with regard to your question on the non-MFI book, I read out the numbers to you earlier. The important thing is that we have disclosed to the street product-wise SMA. We have not aggregated it. So product by product, home loans, loan against property, credit cards, personal loans, consumption financing, vehicles. Every product category we have defined the gross NPA, net NPA, and SMA. Even within SMA, we have given breakup of quarter by quarter SMA. So they're all numbers are stable. So we are, even credit cards, I know a lot of concern on credit cards, but even credit cards for us is behaving quite well.
Okay, yeah, just that, good morning, Mr. Vaidyanathan. Only that part, unsecured loan, if you can repeat for our viewers, what is the experience? Is it a little worse than others, or is it like your other loan category performance? I mean, the NPAs in personal loans, unsecured loans.
Yes. So there are if we for just a minute keep microphones apart, because and just segregate it out and talk for the rest of the book. Like I said before, our credit card NPA. I'll pull out the numbers as discussion progresses and specifically read out those numbers to you. But our credit card numbers, we have put out the numbers trending for 4 quarters. Our gross NPA, net NPA, and credit cost are all trending downwards.
Okay. So unsecured is not a problem for you. It is only the MFI.
So as I spoke to you, I just got the numbers, so just permit me to read them out to you.
Sure.
Our credit card numbers, gross NPA is 1.91%, and net NPA is 0.53%. And, the rest of the book is anyway stable. So we are clearly seeing that our asset quality, excluding MFI, now it's been like 15 years. So nothing suddenly changes once in a year. We even put out 15-year trend, 4-quarter trend, product-wise. So we are seeing it's quite stable.
Okay, so you're saying that your unsecured is not the problem, MFI is the problem. The other issue that the street will have is with the fall in margins. It's fallen to 6.04. You were at 6.4 2 years ago and 6.18 quarter ago. This is because of the rise in cost of funds, cost of deposits?
No, our cost of deposit is 6.38 for 3 quarters in a row. So that's also quite stable. We're running a pretty stable machine by now. And still deposit, of course, is growing. The thing is, why it has come down is because we started to doing more of corporate loans now. Because the corporate entire cycle that India saw between 2015-16, right up to 2 years ago, that cycle has cleaned itself out. The incremental credit behavior on Indian corporate sector is quite good. And we are doing it. Cost income ratio is also quite low, just 31% in corporate book. So what happens is that, of course, the yield is relatively lesser than retail, but the cost income ratio is also better. In an overall economic sense, we're quite comfortable with that. It doesn't mean we're like going headlong into corporate, not confusing anybody here, except that we're getting more comfort with it. I must point out to your viewers and to everybody publicly on record, it's been 6 years since the merger. We have disbursed close to 40,000 crores of corporate loans. There is not a single account in even gross NPA, not even net NPA. So that is zero NPA gross, zero net. So we are running the book in a very tight manner, and that is at the heart.
Mr. Vaidyanathan, if I could just come in over there, that's a really interesting point you made. And I don't think I personally remember hearing that from you in the last few quarters at least, because the focus for the bank has been very much retail over the last several quarters, right? Now you're saying that you're looking and willing to build on the corporate book as well. If you could just expand on that, say, by end FY26, what's the kind of growth in corporate you see? And what, generally speaking, what will the mix be on the book? There's MFI, there's retail, and now you're building corporate. So just give us some sense in terms of strategy for the next 1 year.
So just to be clear, I'm happy you drill deeper on that. There's no swing of strategy that suddenly we're going to go corporate. No. So let me clarify that. So thank you for asking. We have 3 businesses, what we call traditionally known as RAM in the industry. There's retail, agri, MSME. I told you the numbers. They're all, rock stable. And let me just tell you the specific numbers of retail NPA. Retail NPA is 1.63% gross, 0.59 net, and SME is only 0.82%, even less than 1%. So we're quite happy with that. But incrementally, we're also doing corporate. Like, let me think of a growth of like 20% or so, or 23-24%, because that book is also a good book. End of the day, we are a universal bank. We are not only a retail bank. We're a universal bank. We have trade, FX, we have salary accounts. That's also an important part of it.
Mr. Vaidyanathan, I think Surabhi's question is not that. Will you be upping the ante more on corporate loans? So if your margin is 6.04, should we be prepared for 6 or sub 6? That's the point.
Okay. I'll answer that specifically. So it's not, let me answer that. It's not like a dramatic swing happening towards corporate. Okay. We just like to grow it just almost in line with the retail book now. We don't want to swing more towards retail, etc. It's already doing
that's
well.
A fair point. But what is your margin guidance?
20%. First of all, we'll expect retail grow by 20%, wholesale by 20%, blend, something like that. Now to your margin thing, we think that roughly around the 6-ish odd % we should be able to sustain in the longer run. Next year, of course, is because base effect of MFI will not be there. So income growth of the bank will, traditionally income growth has been like 20% and all. Maybe it will come down a little lesser. But the important thing, OPEX also will come down. So we believe that the next year is a transient year. And then after that, the next 4-5 years, we see a one-way track. So a short question on NIM as such, we expect some stability from here.
Okay.
All right. Mr. Vaidyanathan, it's a pleasure, sir. Thank you very much for joining us and sort of patiently running us through all of the numbers, and we wish you the best of luck. as you go forward, and look forward to our next chat.